Welcome back to the deep dive. Today we are strapping in for quite an intense look at the core of global trade. We're using the Q1 2025 Precious Shipping Limited, that's PSL newsletter, as our navigational chart really. And this isn't just your standard earnings report. It's, a full spectrum analysis, covers the global dry bulk freight market set against some truly seismic macroeconomic and geopolitical shifts going on right now.
It really is. It's a gold mine of data if you want a quick shortcut to getting up to speed on global logistics. Our mission today is pretty concise. We're going to try and extract the most crucial financial, operational, and macro insights from this really comprehensive stack of sources. And it's worth remembering, PSL operates mostly in those smaller, more flexible segments, handy-size and supermax dry bulk carriers, which makes their results a really good proxy, I think, for the global movement of what they call minor bulks. Think, specialized industrial stuff like cement, finished steel, fertilizers, grains, that kind of thing.
Right. And looking back at Q1 2025, the main theme, it seems, was just extreme market volatility. Is that fair?
Oh, absolutely. Extreme is the word. We saw huge swings in freight rates, major shifts in geopolitical alignments, which created all sorts of trade route chaos. And on top of that, there's this lingering uncertainty about how new environmental regulations are actually going to shake out in practice.
Okay, so there's this kind of split picture then.
Precisely. That's the dichotomy we need to frame this around, because on the surface, PSL reported a painful and significant financial reversal in Q1 2025. That's the immediate headline news, right? The loss.
Yeah.
But then when you peel back the layers and you look at the underlying dry bulk market indicators, specifically the long-term supply constraints driven by, an aging fleet, regulatory mandates, the longer-term outlook actually suggests increasing structural tightness in the market, even if the short-term demand picture remains, shaky and pretty mixed.
Okay, let's unpack this first part then. Starting with the immediate painful consequence of that volatility, their Q1 2025 financial report card, #text, Precious Shipping's Q1 2025 financial report card. The contrast between, say, Q1 2024 and Q1 2025, it's pretty jarring, isn't it? We're going from a relatively strong quarter a year ago, maybe not booming, but solid, straight into a significant loss this time around. What are the headline numbers that really illustrate this dramatic shift?
Well, the best single indicator, I think, for their operational health is the daily earnings per ship. In Q1 2024, PSL was averaging $12,433 per day per ship, which was, a healthy number. But fast forward just 12 months to Q1 2025, those average daily earnings plummeted down to just $8,641. It's a sharp, immediate decline. And it translates directly to the shareholder report, of course.
Yeah, you see it right on the bottom line, the severity of the market conditions. They flipped from a comfortable net profit of nearly $11.4 million US in Q1 24 to a net loss of $4.14 million US in Q1 25. That's more than a $15 million swing in just 1 year.
And you can see that immediate financial pressure showing up right away in the EBITDA as well, which crashed from just over $20 million down to $8.33 million. EBITDA, it's such a critical measure of cash flow health, so dropping by nearly 2/3 in a year. That signals genuine operational stress.
Right.
And for their Thai investors, this resulted in a loss per share of Baht 0.09. It's really the clearest marker you can have of a deeply difficult trading environment at that time.
Okay, so let's dig into the why behind this. Was it a cost problem or expenses running away? Or was it purely a revenue shock?
Overwhelmingly, it was revenue. Pure shock on the income side. According to the report itself, the primary driver was, and I'm quoting here, a very weak freight market. Rates basically collapsed, particularly in January and February 2025. Now, those months are often seasonally weak anyway, but this was apparently unusually severe.
Okay.
And this weakness resulted directly in a 32% lower net vessel operating income. When your core income stream just drops by nearly a third like that, your profit margins evaporate pretty much immediately.
And even with that revenue plunge, the cost side wasn't exactly helping out, though there's an interesting currency twist, isn't there, with the Thai baht?
That's right, yeah. It's a bit nuanced. The actual U.S. dollar-based operating expenses, the OPEX, they actually crept up slightly. Went from about $5,379 per ship per day in Q1 24 to $5,425 in Q1 25. So that shows you the underlying costs of global operations, things like crew, maintenance, insurance. It continues to inflate. It's getting more expensive to run these ships. But the nuance is that because the Thai baht appreciated against the U.S. dollar during this specific period, those same operational expenses looked 4% lower when PSL measured them in their local currency, in baht. So it's like an accounting benefit, really. It softens the blow of rising dollar costs when they report locally, but internationally, in the currency they actually operate in mostly, they are still paying more.
Got it. So a slight cost increase in real terms, but masked a bit locally by the exchange rate. And that operational squeeze, the lower revenue and slightly higher costs, that was compounded by rising debt costs too.
Exactly. Their finance costs rose by a noticeable amount, baht, 24.90 million. And the report directly attributes this increase to increased loans and debentures on their balance sheet, which is likely related to their ongoing fleet renewal program, which we should definitely talk about in a moment. To try and offset some of this pressure, PSL did realize a small gain, about baht 25.53 million. That came from the strategic sale of one of their older vessels during the quarter. So you can see they're actively managing their assets, trying to sell off older, maybe higher cost units to mitigate some of the loss in charter revenue.
Okay. Before we move fully onto strategy and fleet, let's just quickly touch on their current operational footprint. What did it look like at the end of Q1? As of March 31st, 2025, they had 39 vessels actually on the water, right? And 4 more under construction.
That's correct. 39 operating, 4 new builds on the way. And the report also provided an update on that quite complex legal situation they're involved in Nigeria, involving the vessel Chayanee Naree.
Ah, yes. That's been ongoing for a while. What's the latest there?
Well, the situation remains pretty serious for the management team, you'd have to assume. The Federal High Court in Nigeria apparently rejected PSL's no-case submissions concerning the drugs that were found on board that vessel. What the decision means, effectively, is that the defendants, so the crew members involved and any associated parties, they're now required to file a formal defense and proceed to a full trial. The next hearing was scheduled for May 2025, according to the report.
Right. So that's definitely not resolved. It's not just a financial footnote. It's a major operational and legal issue that must be taking up significant management attention and resources.
Absolutely. It's a serious distraction, at the very least.
Okay. So while those legal challenges are sort of a day-to-day headache for management, the real measure of their strategy going forward lies in how their specialized fleet performed against the global benchmarks, especially in that tough market. #2, fleet performance, charter strategy, and corporate standards. So we know the geared fleet, the handy and super sizes that PSL focuses on, had less volatility than the giant cape sizes during the quarter. But when we dive into the actual market segmentation, PSL's ships apparently underperformed the key Baltic indices. What are the specifics there? How much did they lag?
Yeah, this is a really critical point, and it needs a bit of explanation for, for listeners trying to understand their performance. So PSL's handy-size fleet earned an average of $8,353 per day. That was actually 7.7% below the Baltic Handy-Size Index, the BHSI time charter rate, which averaged $9,053 for the quarter.
Okay, nearly 8% below the index for handies. What about the Supras?
Similar story, actually a bit worse. Their Super Ultra fleet earned $9,066 per day. And that was 12.4% below the Baltic Supermax Index, the BSI rate, which came in at $10,355. So yeah, on the face of it, if you just look at those numbers, it might look like poor trading execution or something.
Right. You'd immediately think they're not fixing their ships well. But that simple comparison is misleading, isn't it? Because of the actual physical assets PSL operates. Can you explain why their vessels are sort of inherently designed almost to earn less than those specific index standards?
Absolutely. This is key context. We need to remember that PSL runs predominantly geared vessels. These are ships that carry their own cranes on deck. That gives them immense flexibility. They can load and unload themselves. That means they can serve smaller ports, older ports, maybe less sophisticated terminals that don't have their own shore-based lifting infrastructure.
Yeah.
That's their niche, their advantage. However, the trade-off is that these geared vessels, especially the ones PSL operates, are deliberately smaller than the standard vessels used to calculate those benchmark indices, the BHSI and BSI. PSL's handy ships are, on average, about 20% smaller in deadweight tonnage than the standard BHSI index vessel. And their Supras are about 10% smaller than the standard BSI index vessel.
Ah, okay. So the index is based on larger ships, generally.
Exactly. Since the index rate calculation is based on the average performance of these larger, often gearless ships, which rely on port cranes, PSL's smaller, geared ships will naturally command a lower absolute daily rate simply because they are carrying less cargo per voyage. They have lower deadweight tonnage, or DWT.
So that apparent underperformance against the index, it's primarily a size and type differential, not necessarily a trading deficiency. Is that fair?
Largely, yes.
Right.
They are essentially sacrificing potentially higher average daily rates on paper for greater operational flexibility and access to those niche markets where their geared ships excel. That's the strategic trade-off.
Okay, that makes sense. And they use long-term charter agreements as well to try and hedge against the volatility that still exists, even in their somewhat less volatile market segment.
Yes, that's a core part of their strategy, locking in revenue where possible.
So how much stability have they actually managed to lock in through those long-term charters looking ahead?
Well, PSL's stated intention, according to the report, is to continue chartering ships out long-term, whenever it's practical, and crucially viable from a rate perspective. For the current year, 2025, they've already fixed 34% of their available ship days on long-term time charters. That gives them a really crucial, predictable stream of revenue, insulating a third of their fleet days from the spot market swings.
Okay, 34% for this year. What about further out?
Well, as you'd expect, this fixed portion predictably declines the further out you look. They don't lock everything in years in advance. It drops to about 10% by 2028 and 2029. But having that 34% fixed for 2025 gives the management team significant breathing room in what's clearly a challenging market right now.
And the actual revenue stream they have visibility on from those locked-in charters over the next few years. It's remarkably robust, isn't it? It seems to suggest they're betting on rates increasing in the future.
They really are showing immense confidence in the medium term, yeah. PSL has USD 163.49 million in visible contracted revenue already locked in over the next 4 years from these charters. But what's even more compelling, I think, is that the estimated average time charter rates on those locked-in contracts actually increase quite significantly over that period. They estimate it rising from an average of $12,158 per day in 2025, up to an estimated $15,000 per day by 2028-2029 on those same contracts.
Wow. So they're not just locking in stability, they're locking in stability at increasingly higher rates for the future.
Exactly. That isn't just stability. It's a clear forecast baked into their contracts that they expect the market to tighten considerably. It validates their long-term strategy, or at least their view of the market.
And that strategy is heavily reliant on fleet renewal and increasingly sustainability. What's the core action plan there? How are they managing the fleet itself?
The plan seems very clear and consistent. Continuous, systematic renewal. They are actively selling their older ships, particularly those that lack modern eco-engines, and replacing them with younger, often slightly larger, and definitely more fuel-efficient vessels, preferably ships under 10 years of age. This approach achieves two things. It manages their regulatory risk exposure, especially with rules like EECI and CII coming in, and it optimizes their fuel consumption, which is their single biggest voyage cost.
And we saw immediate action on this in Q1 2025 itself, right? They actually did a transaction?
Yes, exactly. They completed the sale of a fourth older vessel during the quarter, and they immediately replaced it with a second-hand but modern eco-engine Ultramax vessel, which actually joined the fleet in April, just after the quarter ended. They also mentioned they have 4 newly built, conventionally fueled Ultramaxes scheduled for delivery in 2026, and they're marketing these quite heavily as being designed to be the lowest fuel-consuming ships of this size. So the focus is squarely on efficiency within today's available technology.
Right. And what's fascinating here, as the report explicitly notes, is their deliberate wait-and-see approach regarding the next wave of decarbonization technology. You know, things like alternative green fuels, methanol, ammonia, hydrogen.
Yes, they're extremely cautious here, and arguably rightly so, given the current uncertainties. PSL is intentionally avoiding what they describe quite pointedly as the expensive trap that many first movers have fallen into.
Meaning investing heavily in a technology that might not be the winner.
Precisely. They see the current environment as lacking regulatory clarity. Nobody really knows what the final IMO 2050 pathway will mandate, and maybe even more importantly, lacking viable global supply chains for these potential true green fuels. Where do you bunker methanol reliably worldwide today, or ammonia safely? They clearly don't want to invest hundreds of millions of dollars into a ship designed for a specific fuel, only to find out the fuel isn't available, or that regulations favor a different pathway in 5 or 10 years.
So optimize for the current operational environment, fuel efficiency, size, gear, while preserving capital and flexibility for the eventual inevitable technology shift whenever that becomes clearer.
That seems to be exactly the strategy. Optimize for today, wait for clarity on tomorrow.
And this careful, long-term strategic approach, it seems reflected in their corporate standards, too. The report makes a point of highlighting these, almost as a measure of underlying stability despite the headline financial loss.
Absolutely, and I think that's fair. Management stability and governance quality are reflected in these non-financial accolades they list. They achieved an AA rating in the Stock Exchange of Thailand's ESG rating for 2024. They were included in the Thailand Sustainability Investment, THSI, list for the fourth consecutive year. And maybe most impressively, they've maintained an excellent corporate governance rating from the Thai Institute of Directors for 15 consecutive years now, running all the way from 2010 to 2024.
15 years of excellent governance. That's quite a streak.
It really is. And these achievements, they tell investors and partners that even if the short-term market is chaotic and volatile, the company's internal structures, its governance, its management quality are considered rock solid and consistent. That builds confidence.
Okay, let's pivot now from PSL specifically to the huge macro trends that are really overshadowing these quarterly numbers. Starting with the supply side of the shipping equation. The report suggests the long-term fundamentals for supply tightness actually look surprisingly robust. How can that be true when we still see new ships being delivered? Isn't the fleet growing?
Well, it is growing, but the key is the balance between new deliveries and the number of old ships nearing retirement age. That's where the picture gets interesting. We look at the forward order book to fleet ratio. That's the total deadweight tonnage of ships currently ordered compared to the total deadweight tonnage of the fleet currently on the water. Right now, that ratio stands at 10.26% for deliveries scheduled through the end of 2028.
Okay, 10.26%.
Now, here's the crucial comparison. That 10.26% is only marginally higher than the percentage of the current fleet that is 20 years old or older, the prime candidates for immediate scrapping. That segment, the 20-plus-year-old ships, currently stands at 10.18% of the fleet.
Wow. So the order book barely covers the really old ships.
Exactly. For the first time in decades, really, the global order book for dry bulk carriers only just exceeds the size of the aging, arguably obsolete part of the fleet. This structural balance is potentially immense, because if that 10.18% of old ships are forced out, perhaps by new regulations or simply high running costs, then the net fleet growth over the next few years could actually be very, very small.
Right, that makes sense. If scrapping matches deliveries, the fleet size stays flat. However, you said if they're forced out. The report notes that actual recycling, actual scrapping was pretty low in Q1 2025.
That's the caveat, yes. The regulatory pressure needs to actually translate into ships heading to the scrapyards. Q1 2025 saw quite low recycling volumes. Just 1.11 million deadweight tons, MDWT, were reported scrapped. And that low number contrasts sharply with that enormous 10.18% chunk of the fleet that's over 20 years old and still sailing.
So what's the mechanism then? What will actually force those older ships off the water and onto the beaches in India or Bangladesh?
It really comes down to the cost of compliance. The expectation or hope in the report is that healthier levels of recycling are coming soon, driven by several compounding regulatory pressures. First, you've got expensive mandatory upgrades, things like ballast water treatment systems, BWTS. Yeah. Installing one on an old ship can cost millions of dollars. Is it worth it?
Right.
Then you have the regular special survey costs, which get progressively more expensive as a vessel ages. Passing a 20 or 25-year special survey can require huge amounts of steel replacement and other work. Again, is it worth the investment on an old ship? But crucially, layered on top of that now, we have the new efficiency rules from the IMO, EEI and CII.
Okay, break this down quickly. EEXI and CII.
Sure. ESI is the Energy Efficiency Existing Ship Index. It essentially mandates a one-time certification that an existing ship meets a certain technical energy efficiency standard. Older ships might need engine power limitation, EPL, or other modifications to comply. CII is the carbon intensity indicator. This is an operational measure. Ships get rated annually from A to E based on their actual carbon emissions versus the cargo carried, and the requirements get stricter each year. Ships rated D for 3 years or E for 1 year have to submit a corrective action plan.
So these rules basically act as a kind of mandatory speed limit, especially for older, less efficient ships?
Effectively, yes. To meet EXI, owners might permanently limit engine power. To maintain a good CII rating year after year, especially as the targets tighten, older ships will likely have to sail slower, what's called slow steaming. Sailing slower directly reduces the effective supply capacity of the global fleet. A ship doing 10 knots delivers less cargo per year than one doing 12 knots. So for many owners of these older, less efficient vessels, the combination of paying for BWTS, facing huge survey costs, and being forced to operate slower just makes the ship economically unviable. That's what should push them towards demolition.
Okay, that makes the supply picture much clearer. Potential for very low net fleet growth if these pressures bite. And here is the silver lining, as PSL specifically called it in the report, that supports future rate strength. New orders seem to be collapsing.
Yes, this was a striking statistic for Q1 2025, a really dramatic slowdown in new bulk carrier contracts being signed. Only 1.44 million deadweight tons of new orders were placed globally in the entire quarter. To put that in perspective, that's a staggering 89.5% drop compared to the orders placed in Q1 of the previous year, 2024.
Wow, an almost 90% drop in new orders year on year. Why such a sudden halt?
Well, the report suggests it's likely a combination of factors. Ship owners are probably spooked by the regulatory uncertainty we just discussed. What kind of engine should I order for a ship delivering in 2027 or 2028? Plus, new building prices at shipyards remain very high. And maybe financing costs are biting too, with higher interest rates globally. But whatever the reason, if owners aren't placing new orders now, that provides a very strong structural floor for the market in the medium term, say 3 to 5 years out. Fewer ships delivering in the future means supply stays tight.
Okay, that's the supply side potentially very constrained. Now let's talk about the market indicator that actually drove PSL's quarterly loss.
Yeah.
The BDI, the Baltic Dry Index, described in the report as a complete roller coaster in Q1.
It truly was a dizzying ride.
Yeah.
The BDI, the overall index, started Q1 2025 down to 1,029 points. That reflected the weak January and February period we mentioned earlier, but then it spiked really sharply, peaking up at 1,669 by mid-March. And this massive volatility, the report emphasizes, was almost entirely driven by just one segment, Capesize ships, the huge ones.
Right. And why are the Capesizes such a major factor in the overall BDI?
They're the heavyweights, literally and figuratively. Capesize vessel routes, mostly carrying iron ore and coal on very long hauls, account for 40% of the entire BDI calculation. So when Capesize rates swing wildly, the whole index swings wildly, and they saw extreme swings in Q1. Daily earnings dropped to a trough of just $5,899 per day in February, before rocketing up to a peak of $23,992 per day in March.
That's an incredible range in just a few weeks, from under 6K to nearly 24K.
Absolutely. The January and February trough is somewhat traditional. It's often linked to the industrial slowdown in China around the Lunar New Year festival. Less demand for iron ore and coal temporarily. But the strength and speed of the rebound in March was quite sharp and perhaps a bit unexpected.
Okay. But what's crucial for PSL, operating mainly Handys and Supras, is the contrast with their specific sector, the geared ships. How did they fare during this Cape roller coaster?
Well, the geared sector, the Supermaxes and handy sizes, experienced much lower volatility. Their rates were far more stable, albeit at those lower levels we discussed earlier. The report specifically attributes this relative insulation to the slower net growth rate in deadweight ton supply for these smaller segments, compared to the massive swings we see in the Capesize and Panamax fleets. So while the giants of the fleet were bouncing wildly between feast and famine, PSL's specific market had a far steadier, though still depressed, trading environment during Q1.
Right. Stability, even if it's low stability, is better than wild swings sometimes. Okay, let's move to the demand side of the equation now. Looking at the concept of ton-mile demand that's volume multiplied by distance, we saw apparently huge growth in ton-mile demand in 2023 and into early 2024, essentially matching the boom years of the mid-2000s before the financial crisis. What drove that?
Yeah, that was a bit of an artificial boost, really. Ton-mile demand growth was high, around 5.4%, which is very strong, but it was largely driven by geopolitical events and disruptions, not necessarily underlying economic strength. Wars like the Russia-Ukraine conflict led to shifting trade patterns. Think Russian coal going east instead of west, longer voyages. And crucially, the trade route disruptions, particularly the attacks on shipping in the Red Sea by the Houthis in Yemen, that forced vast numbers of ships, including bulk carriers, to reroute all the way around the Cape of Good Hope in Africa instead of using the Suez Canal.
And that adds thousands of miles to voyages,
Yeah,
right?
exactly. Significantly longer routes. So even if the actual volume of cargo being shipped didn't change much, the distance it traveled increased dramatically. Longer distance multiplies the demand for vessels, effectively reducing the available supply because ships are tied up on voyages for longer. That artificially boosts ton-mile demand figures.
Okay, so an artificial boost from rerouting, but the forecast for 2025 ton-mile demand, according to the report, is a sharp slowdown.
Yes, the forecast cited is pretty cautious, only 0.26% ton-mile demand growth projected for 2025, basically flat. And this projection explicitly includes the risk or the possibility of a potential dissuader, although they note it seems unlikely right now, unwinding of those Red Sea disruptions. If, for example, a ceasefire was reached and ships felt safe using the Suez Canal again, That could suddenly release a lot of capacity back onto the market very quickly. The report estimates that the Red Sea rerouting added about 1.2% to effective bulker demand in 2024. So if that goes away, it's a direct hit to demand.
Right, removes that artificial inflation. And here's a really interesting paradox the report touches on. We mentioned earlier that the regulatory slowdown from EXIC is forcing ship speeds down. They hit a record low in February 2025, apparently. That should tighten supply. Yet the report also says that decreased fleet inefficiencies specifically, fewer port delays in some segments actually released capacity, pushing rates down. How does that work?
Yeah, it's a counterintuitive market effect, isn't it? You can sort of imagine the market supply like a rubber band.
Yeah.
Regulatory compliance like EEXI and CII forcing slower speeds is slowly, structurally stretching that band tighter. It's removing capacity over the long term.
Yeah.
But if ports globally or even regionally suddenly become much more efficient, maybe less congestion, faster loading and unloading, then ships spend significantly less time just sitting around waiting. That time saved immediately releases that vessel's capacity back onto the market right now.
Ah, okay. So a short-term efficiency gain can flood the market temporarily.
Exactly. That released capacity temporarily floods the spot market, adding immediate downward pressure on freight rates. Even though the underlying long-term structural supply might actually be tightening due to those slower sailing speeds mandated by regulation, it's these conflicting short-term and long-term pressures acting at the same time.
And despite any temporary efficiency gains, the report makes it clear that port congestion, just ships waiting around, remains a massive structural capacity drain overall. They provided some pretty concrete data on how much time is simply lost in port.
The numbers are frankly staggering when you look at them annually. In 2024, the average handy-sized bulker spent 144 days just sitting in port, either waiting, loading, or unloading. It's 39% of the entire year gone.
Wow, nearly 40% of the year unproductive.
And Supermaxes were even worse. They spent, on average, 172 days in port in 2024. That's 47% of the year, nearly half their time. Now, the report notes that Panamaxes actually saw the sharpest improvement in port times, down 15.2% compared to 2023. But even with that improvement, they still spent 187 days in port on average.
So even the improved segment is spending more than half the year tied up in port operations.
Precisely. So even if there are slight efficiency gains here and there, the fundamental reality is that these vessels are still tied up for somewhere between, say, 1/3 and often over half the year just dealing with port operations. That inherent inefficiency is a massive, permanent, structural restriction on actual vessel availability. It keeps a lid on effective supply, regardless of how many ships are technically floating around. Hashtag 5E. Geopolitics, tariffs, and economic anxiety.
Okay, this is where the narrative in the PSL report really shifts gear, moving from market dynamics to, well, what feels like a pure global chaos sometimes. It devotes quite significant attention to the geopolitical environment, and particularly that event they refer to as the Liberation Day tariff shockwave announced back on April 2nd.
Oh.
What was that about?
Yeah, the report neutrally lays out the facts of what happened and refers to the announcement of aggressive new U.S. trade policies. Specifically, sweeping 10% tariffs proposed on pretty much all imports into the U.S., with hints of significantly higher targeted rates for specific countries later on. The stated aim, apparently, was to force a major rebalancing of global trade flows. But the immediate financial market reaction, well, it wasn't subtle.
Not subtle at all. The report describes genuine investor panic.
Absolutely. Within just 5 short trading days after that announcement, the S&P 500 dropped 4.6%. The tech-heavy NASDAQ 100 fell even harder, 8.3%. And the Russell 2000 index, which is often seen as a key indicator of smaller, more domestically focused U.S. company health, that declined 9.8%, nearly 10% in a week.
And the sheer scale of the value destruction mentioned is immense.
It really is. The report calculates that over $3 trillion was wiped off the value of the U.S. stock market alone in those 5 days, and globally. The total hit to world stock markets was estimated at $9.5 trillion erased in just that 5-day trading period. I mean, $9.5 trillion. That's almost a quarter of annual U.S. GDP vanishing from market caps in less than a week.
That kind of shock signals that investors clearly believed this wasn't just, political posturing. They saw it as a fundamental, potentially damaging change to the architecture of global trade.
That seems to be the interpretation, yeah. And the broad economic consensus, as cited in the report, was pretty dire. Economists generally view these kinds of broad tariffs as causing a negative supply shock. They act like a tax on imported inputs for manufacturers and on finished goods for consumers. That raises prices, which fuels that sticky inflation the Fed was already struggling with. And of course, higher prices and disrupted supply chains tend to hurt economic growth, leading some economists cited in the report to put the probability of a U.S. resign hitting 50-50.
Okay, wait. If this tariff shock is potentially so severe for the global economy, how does it affect dry bulk shipping specifically? And PSL? Are they just caught in the crossfire, or is there more to it?
Well, somewhat surprisingly, they seem relatively insulated, at least in the dry bulk trade itself. This is a really crucial nuance the report highlights. The direct China-U.S. dry bulk trade is actually pretty small potatoes in the grand scheme of things. U.S. dry bulk imports, things like cement or fertilizers maybe, account for only 2.4% of China's total dry bulk imports, which are dominated by iron ore and coal from Australia, Brazil, etc. And China's dry bulk exports to the U.S., even tinier, just 1.7% of China's total dry bulk exports. So the report argues any direct tariff war in the dry bulk space primarily hurts U.S. consumers and manufacturers who rely on those specific minor bulk imports, rather than significantly disrupting China or the major global dry bulk commodity routes.
Okay, so the direct impact on their core commodities might be limited, but the report goes further, doesn't it? It suggests this trade chaos could actually create a competitive advantage for a company like PSL.
Yes, this is where it gets really interesting. It's like a potential golden ticket for smaller, non-aligned carriers like PSL. The specific USTR, U.S. Trade Representative maritime action that accompanied the tariffs, the part imposing fees on certain vessels calling at U.S. ports, apparently contains a key clause in Annex 2 that provides a massive loophole for them. It explicitly exempts bulk carriers that are 80,000 deadweight tons or less, and also exempts ships arriving empty, perhaps to load U.S. exports like grain.
80,000 DWT or less, and PSL's fleet.
Well, PSL's largest vessel, according to their fleet list, is a 63,500 DWT Ultramax, so their entire current fleet falls safely under that 80,000 DWT exclusion threshold. Which means, according to the report's interpretation, they are completely free from these new USTR fees when their ships call at U.S. ports.
That's incredible. So it fundamentally alters the competitive landscape for carrying specific U.S. import or export cargoes, doesn't it?
It seems to create a de facto two-tier market, as the report puts it. Ships that are larger than 80,000 DWT, so Panamaxes and Capesizes mainly, or potentially those owned or operated by specific flagged entities that might be targeted in the USTR action. They could face materially higher voyage costs when serving U.S. ports because of these new fees. Meanwhile, PSL's smaller, geared, non-Chinese built or operated vessels can trade freely without that extra burden. So theoretically, they could potentially charge slightly higher rates for U.S. cargoes because their direct competitors are suddenly saddled with a new tax that PSL doesn't have to pay.
A potential competitive advantage born from trade chaos. That's quite something. The big downside risk remains, though, as the report warns, a U.S. recession caused by these tariffs dragging down the rest of the world economy.
Absolutely. That's the macro overhang.
Yeah.
The relative advantage on U.S. trades doesn't help much if global demand collapses across the board due to a recession. But in terms of relative positioning versus larger ships or specific competitors, PSL seems to benefit directly from this aspect of the trade turmoil.
Okay, let's broaden out again and review the global economic forecasts that were informing all this anxiety around the time the report was written, starting with the IMF revisions.
Yeah, the IMF had clearly factored in these rising trade tensions and geopolitical risks when they updated their forecasts. They lowered their global growth forecast for 2025 down to 2.8%, which is, fairly subdued. U.S. growth specifically was revised down to just 1.8% for 2025. And China, the big engine for commodity demand, was reduced to 4.0% growth for both 2025 and 2026. Still growing, but slower than hoped.
Any bright spots mentioned?
The main one highlighted was India. It was projected to grow by a strong 6.2% in 2025, really solidifying its position as the world's fastest-growing major economy. That has implications for future dry bulk demand, as we'll discuss later.
Right, and that sticky inflation, potentially made worse by the tariff costs, seems to have really trapped the U.S. Federal Reserve's monetary policy, didn't it?
It absolutely appeared to have done so, yes. At the time of the report, the Fed had paused its rate cuts. They were maintaining high interest rates. The benchmark rate was sitting at 4.25% to 4.5% as of March 2025. And their projections at that point only signaled maybe 2 small cuts later in 2025. This reluctance to cut rates faster reflected their clear concern that the added costs filtering through from tariffs would keep inflation stubbornly high, which forces interest rates globally to remain higher for longer, making financing, debt service, everything more expensive for everyone, including shipping companies borrowing to build or buy ships. Okay. And beyond the economics, we absolutely must address the immediate geopolitical conflicts that are fundamentally reshaping trade routes and alliances. The report provided an impartial review of the major wars and their potential implications. Yes, and we have to acknowledge the tragic human reality of these ongoing conflicts when we discuss the economic impacts. In Ukraine, the report, just neutrally reporting observations at the time, noted that Russia was increasingly being viewed by analysts as the likely eventual winner on the battlefield. This was linked to perceptions of fading U.S. military support and an expectation that Europe would likely have to shoulder the long-term security burden and reconstruction costs in the region. Meanwhile, the conflicts in Gaza and involving Yemen were continuing with intense fighting and, of course, creating severe humanitarian crises. The report makes a general point here that war, whether it's fought with weapons or through economic means like tariffs, ultimately leaves pretty much all participating sides as losers due to the massive economic destruction and, more importantly, the human toll involved.
And these conflicts have a direct, tangible consequence for global shipping by threatening those critical maritime choke points.
Yes, these narrow waterways are the indispensable arteries of global trade. The report flags the big three. The Malacca Straits between Malaysia and Indonesia carry something like 24% of all world trade. The Suez Canal, now frequently disrupted, normally handles about 9% of world trade. And the Panama Canal, facing its own issues with drought, handles about 3%. Conflicts happening anywhere near these regions immediately increase risks, jack up insurance premiums for ships transiting, disrupt schedules, and force that costly rerouting which, as we discussed, artificially boosts ton-mile demand but adds huge costs and inefficiency. Okay. Finally, within this really intense geopolitical context, the PSL report cited a critique from Professor Kishore Mahbubani regarding Europe's strategic position. It sounded like quite a provocative view. It is provocative, yes. And again, it's important to stress, PSL is citing Mahbubani's analysis, not necessarily endorsing it wholesale. Mahbubani, a well-known Singaporean diplomat and academic, argues in the cited work that Europe has significantly lost geopolitical standing and influence. He contends that Europe must seek greater strategic autonomy, becoming less dependent on the U.S.-led alliance structure. Part of his argument is driven by the high economic cost of this dependence, particularly on energy. He notes, for instance, that the cost of U.S. liquefied natural gas, LNG, imported by Europe after the cutoff of Russian gas was apparently 4.44 times higher than the Russian piped gas it replaced.
Wow, over 4 times the cost.
That's the figure cited. And Mahbubani suggests some quite radical options for Europe to regain leverage and pursue its own interests. 1. Find some kind of strategic bargain with Russia that addresses core security interests for both sides. 2. Credibly threaten to leave NATO, not necessarily to actually leave, but to gain more respect and agency within the alliance from the U.S. And 3. Partner more closely with China, focusing on shared challenges like demographic shifts and economic development, rather than following a U.S.-led containment strategy. Again, this isn't PSL saying Europe should do this. It's them citing a prominent external analysis that highlights the deep fractures and potential realignments happening within the established Western-centric global order. It shows how unstable things feel. #VV, long-term global trends and industry standards.
Okay, let's shift back from the immediate crises to some massive long-term structural trends that fundamentally fuel dry bulk demand. The report highlights 2 huge ones, starting with the urbanization imperative.
Yes, urbanization is really the bedrock of industrial commodity demand and therefore dry bulk shipping demand. The report notes the global urban population reached 58% in 2025. More people live in cities than rural areas now. China's urbanization has been incredible, reaching 67% by 2025. That massive shift from rural to urban over the last few decades is what fueled China's unprecedented demand for steel, cement, coal, iron ore, all carried by bulkers.
Yeah.
But crucially, look at India, now the world's most populous nation, but still only 36.3% urbanized, according to the report. There's still huge potential for growth there.
So what does that future urbanization, especially in places like India, mean specifically for a dry bulk carrier like PSL operating Handys and Supras?
It's a direct, almost guaranteed link to future demand. Higher urbanization correlates directly with increased GDP per capita, massive industrial output as countries build infrastructure and housing, and therefore soaring demand for dry bulk commodities. We need cement for buildings, iron ore and coal for steel production, finished steel products themselves, fertilizers for agriculture to feed the cities. It all moves on bulkers. China already accounts for a staggering 42.2% of all global dry bulk imports. They are the giant. But looking ahead, the report specifically mentions India's explicit government push to build 25 million new homes by the year 2030. That single policy goal guarantees sustained, Massive demand for construction materials over the coming decade, ensuring that smaller bulkers like handy-sizes and supermaxes remain busy carrying the cement, the finished steel, and all the other minor bulk inputs needed for that kind of national transformation. It's a huge demand driver.
Okay, urbanization is one massive driver. The second key long-term driver the report links to shipping is more sociological. It's about inequality and changing consumption patterns, specifically diet. This sounds like a fascinating connection.
It is a critical insight, I think, and one that's often overlooked when just looking at raw economic data. The report highlights that as vast populations transition out of absolute poverty and into the global middle class, the journey that China largely completed over the last 30 years, their diet changes dramatically. People move away from primarily plant-based vegetarian diets towards more carnivorous ones. They start eating more meat and dairy.
Okay, and how does that impact shipping?
Well, the impact on grain demand is exponential. The conversion factor from feed grain to meat is quite steep. The report cites figures like it takes about 2.5 kilos of grain to produce 1 kilo of live weight white meat, like chicken. And it can take up to 6 kilos of grain to produce 1 kilo of live weight red meat, like beef or lamb.
6 kilos of grain for 1 kilo of beef.
Yeah. So the shipping implication becomes really clear. Potentially hundreds of millions, even billions of people gradually starting to eat more meat globally translates directly into an exponential increase in the demand for ships carrying feed grains, primarily corn and soybeans, to feed all that livestock. This deep sociological shift in diet translates directly into dramatically increased demand for the very types of ships the PSL operates, the handies and supers that are workhorses in the global grain trades.
That's a powerful long-term demand driver tied to human development itself. The report also briefly touches on the other side of development wealth concentration and inequality, doesn't it? Mentions some CEO salaries.
It does, yeah. Just briefly notes the stark executive compensation disparities, citing examples like the Citigroup CEO, Jane Fraser, earning $34.5 million, and the Morgan Stanley CEO, Ted Pick, earning $34 million. And it also mentions analysis suggesting the rising importance of hereditary wealth accrued while sleeping, as Piketty put it, compared to wealth earned through labor. I think the implicit link back to the shipping discussion is about global economic access and mobility. The ability of the average person globally to actually attain that middle-class status, the one that drives the changing diets and the demand for shipped goods, is increasingly tied to these broader questions of economic fairness and opportunity.
Right. A subtle but important context. Finally, in these long-term trends, let's look at the immense challenge of climate change and the regulatory chaos that seems to surround decarbonization efforts in shipping.
Yes, the climate data cited is certainly worrying. January 2025 was apparently the hottest single month ever recorded globally, coming in 1.75 degrees Celsius above the pre-industrial norm. And the report notes that the increasing frequency and intensity of extreme weather events, floods, droughts, storms, ironically often increases demand for shipping in the short term. You need more material shipped in for repair and fortification of damaged areas. And widespread crop damage from droughts or floods can force grain cargoes to be rerouted over much longer distances to find alternative supplies, boosting ton-mile demand again.
A grim sort of demand driver. And on the energy side, needed to power both the economy and potentially new ship types, the global picture seems highly fragmented.
Quite fragmented, yeah. Global electricity demand is projected to keep growing strongly, maybe 4% annually. But how that demand is met varies wildly. The report notes a push in parts of the U.S. to actually reverse planned coal power plant shutdowns due to growing concerns about grid reliability and the pace of renewable integration. That contrasts sharply with the EU, which apparently saw record deployment of solar and wind capacity in the same period. This fragmented global energy mix creates real headaches for an international industry like shipping, which has to operate globally and figure out what fuels will be available where and what regulations will apply in different regions.
And this fragmentation and uncertainty seems to lead directly back to the IMO, the International Maritime Organization, and the deadlock described regarding future decarbonization standards for shipping.
Yes, this is clearly a major frustration point highlighted in the report, especially for a company like PSL that seems to want clearer regulation. They note that the IMO effectively abandoned a widely discussed proposal for a global carbon levy on shipping fuel, a market-based mechanism that PSL had apparently been actively advocating for. Instead, the IMO moved towards what's described as a weaker compromise proposal. Yeah. And PSL explicitly argues in the report that this compromise proposal will likely be largely ineffective because it tries to please too many conflicting interests and lacks the necessary teeth the strong enforcement mechanisms or financial incentives to really force meaningful technological change or probably fund the transition to green fuels.
So regulatory uncertainty persists, making investment decisions difficult. I want to make sure we highlight PSL's specific ethical stance, mentioned again here, regarding pollution standards they can control today, their rejection of open-loop scrubbers.
Yes, they make a point of this. It's presented as a key commitment to their sustainability goals, even when they're facing financial pressure like in Q1. They state very clearly their company policy refuses the installation of open-loop scrubbers on their ships. Now, these are exhaust gas cleaning systems that spray seawater through the ship's exhaust to remove sulfur oxides, meeting air pollution rules. But they then typically discharge that used wash water, now acidic and containing pollutants, directly back into the ocean. PSL explicitly states they refuse to pollute the sea with this toxic waste. Instead, they choose to comply with the sulfur regulations by burning the significantly more expensive, very low sulfur fuel oil, VLSFO. So they are consciously upholding what they see as a higher ethical and environmental standard, and doing so at a measurable direct financial cost to the company. It's a clear choice they're highlighting. Hashtag tag Mila63. Conclusion and provocative takeaway.
Okay, this has been a true deep dive then. We've gone from an immediate quarterly loss of over $4 million for PSL, all the way through fleet strategy, niche markets, roller coaster indices, collapsing new orders, port congestion, tariff wars, geopolitical shifts, changing diets, and regulatory deadlock. Bringing it all together, what is your synthesis of the overall market outlook presented in the report for the dry bulk sector, looking through the rest of 2025?
Well, it really paints a picture of a powerful collision of opposing forces. The downside risks are immediate, tangible, and mostly demand-side driven. You've got the ongoing geopolitical chaos. You have those aggressive tariffs threatening a general economic slowdown, maybe even a global recession. And asset values for ships were still quite high, which could fall. However, the upside potential is anchored firm, almost stubbornly, in the supply-side fundamentals. You have that historically low order book-to-fleet ratio. You have the massive drop in new ship orders placed in Q1, which shores up the future. You have that specific, maybe unexpected, structural advantage PSL gains from the USTR fee exemption on U.S. trades. And you have the permanent supply reduction being baked in by those regulatory slowdowns like EEXI and CII, forcing older ships to sail slower.
So a tug of war between weak demand signals and tight supply signals. Given all that, where does PSL in the report cautiously suggest freight markets might ultimately land for the full year 2025?
Their overall view, reading between the lines, seems pretty pragmatic, maybe leaning slightly pessimistic due to the tariff shock. They suggest freight markets for 2025 could hover somewhere between the results seen in 2023, which is okay, and 2024, which started stronger. But they explicitly flag a significant risk that the markets could actually fall below the 2023 results. And that downside risk is directly attributed to the potential severe economic shock caused by that latest round of protectionist tariffs, the Liberation Day effect. That $9.5 trillion wiped off global stock markets in 5 days clearly spooked them, highlighting the severity of the potential demand destruction if a trade war really escalated.
Right. But the long-term silver lining, as they called it, remains that supply constraint, particularly that dramatically low level of new ship orders placed back in Q1 2025.
That really seems to be the sector's main structural defense mechanism right now. The aging global fleet, the difficulty and cost of building new, compliant ships quickly, the regulatory pressures removing effective capacity. These supply-side factors are perhaps the only things currently providing some insulation for the dry bulk sector against what could otherwise be potentially disastrous global demand shocks triggered by trade wars or geopolitical events.
Which leads us perfectly, I think, to our final thought for you, the listener, to mull over after this deep dive. We've established that the dry bulk market's future supply tightness, which seems structurally supported by the aging fleet, the low order book, and those mandatory efficiency regulations reducing speed, is maybe one of the only powerful factors currently insulating the sector from these potentially disastrous global trade wars and geopolitical shocks that are hitting demand.
So the question we're left with, the thing to really ponder, is this. If global recession risk does continue to climb rapidly, driven by these escalating geopolitical tariffs, maybe stubborn inflation, keeping monetary policy restrictive. How long can those supply-side constraints we've discussed, like EEXI and CII reducing effective fleet capacity, or just the lack of new ships being ordered, how long can they continue to protect freight rates? Is there a point where A really severe, prolonged drop in global ton-mile demand simply overwhelms those supply-side buffers and causes rates to collapse anyway. Where is that tipping point?
Something to definitely think about as you watch the next move by central banks or read the headlines about the next tariff announcement or geopolitical flare-up.
Indeed. It's a fascinating, if worrying, time for global trade. Thank you for joining us for this deep dive.
We'll see you next time.